Silver investors. Western screens are printing $86, but the biggest recycler in Shenzhen is already paying $95.96 for physical silver, while Shanghai is still closed. That is not sentiment, that is real cash, in size, bidding nearly $10 above your broker's quote before Asia's main pricing engine even comes back online. Segment 1, today's move hit the exact level on the map. Silver opened the week with a gap higher. Western spot and futures jumped through 86.3, ran up to around 87.8, and got rejected exactly from the resistance zone that was mapped out yesterday, the 87.289 band. That level was on the chart before the open, not drawn retroactively, has now proven itself as a real battlefield between longs and shorts. Gold did the same thing. It moved higher into $5,150, matching the PXG signal that went out on X before Western markets opened. So structurally, right now, base gold 5,150. Western silver 86, and for silver to continue toward 92, the rule of the game is clear. It must clear 87.289 with aggression. No camping in that band, no slow consolidation. Staying there too long invites shorts to reload. The next leg up requires a decisive, fast break through that zone that does not give the defense time to settle. That's your immediate technical map. Segment 2, Shanghai reopens into a different world. What makes tonight's session unique is not just that Shanghai reopens, it's what's changed while it was closed. Since Shanghai went offline for Lunar New Year, Western silver has caught up significantly. The price when they closed and the price they're returning to are not the same. So every serious participant is asking one question: where does Shanghai open? And the market may already have given you a preview. China's largest silver recycling firm, one of the biggest scrap buyers in the entire country, was on Monday offering to buy back 99.99% silver at roughly $95.96 per ounce, on a day when Shanghai itself was still closed and Western silver was trading around $86. That's a $9.10 premium over Western paper. This is not a rumor. It is a real business, posting a real cash bid for physical metal during a holiday closure. That tells you this is genuine industrial and investment demand, not just speculative futures flow. If that recycler's pricing reflects where broader Chinese physical demand really sits, then Shanghai's open tonight could be the kind of gap and premium that mainstream media tries to explain after it happens. The people who do their own homework won't need CNBC to tell them why. Segment 3, naked shorts and an options market screaming stress. Under the surface, the structure of the silver market is not calm. Two key points from the data: naked shorts. There are short positions in silver that are not backed by metal. This is not theory, it's visible in the positioning and delivery data. These shorts exist on COMEX and reportedly on the Shanghai exchange as well. Some players are trapped short on both sides with limited ability to hedge properly because of capital constraints. Implied volatility spike. The COMEX implied volatility index for silver, a measure of what options traders are paying for 30-day price risk, has spiked massively. Think of it as a fear gauge. Low, hearts calm, predictable. High, achas, market bracing for violent, unpredictable moves. Crucially, volatility doesn't tell you direction. It tells you there is pressure in the system. Here, the transcript ties that pressure directly to the naked short problem. Charts can't fix unbacked shorts. Only forced liquidations can. And when shorts without metal are forced to cover into a tight physical market, price action does not move politely. There's also a shift in how suppression attempts show up. The big visible intraday price slams in silver futures have become less frequent since last week. Instead, we're seeing patterns in silver futures options, flows that can manage price through volatility and positioning rather than blunt price hits. The vol spike is consistent with that kind of complex management. It's harder to see, harder to prove, but the footprints are there in the CME options data. Segment 4, Mexico. When stability can actually mean more risk for mines now, the supply side, and specifically Mexico. Recent development: Eleno, leader of one of Mexico's most powerful cartels, was killed in a military operation on February 22nd. Immediate aftermath: airspace shutdowns, road blockades, military mobilization. The Mexican government coordinating a national response with U.S. intelligence support. On the surface, that sounds like stabilization, government taking control. But historically, cartel leadership takedowns do not create instant order. They create fragmentation. And fragmentation in regions where mining depends on predictable security means increased risk of kidnappings, more aggressive extortion rackets against mines and suppliers, higher operating costs as companies pay for more security and accept disruptions, investor hesitation, delay of expansion, and capex. Mexico is still the world's largest silver producer. Roughly 1 in 4 ounces mined globally comes from Mexican soil, so any sustained uptick in security risk around Mexican operations is not trivial noise. Right now, there is no documented drop yet in mine output numbers. The risk is structural, not fully reflected in current supply data. That's exactly why the transcript says, this situation deserves continued monitoring, not a checkbox that says resolved. In a market that is already structurally tight, you don't need a huge disruption. You just need enough uncertainty that new investment slows and existing output is less reliable. Segment 5, Middle East hardware and the embedded gold premium. The geopolitical backdrop has not calmed down. According to the video, U.S. military assets, carrier groups, cargo aircraft, remain positioned in the Middle East at levels not seen since 2003. The Iran situation has not resolved, it has paused. Historically, pauses with that kind of hardware in place have a tendency to unpause. They turn into either deals or escalations. While that risk hangs in the air, a risk premium embeds itself into gold pricing. That premium does not disappear until the risk is clearly removed. Right now, it has not been removed. It is simply sitting there, being repriced each day. Today's capital flows reflect that. Gold is adding to Friday's gains, sitting around 5,250. Silver is up over 2% on the day. Stock index futures opened negative. Hard assets up, paper down. That divergence is not random. It's investors voting with their capital on where safety lives. And once that rotation accelerates, it tends to feed on itself in ways a single headline never fully captures. Segment 6. The honest risk. Volatility cuts both ways. This channel is not about hyping you into positions, and the transcript is explicit about that. The same vol spike that can fuel a squeeze higher can hurt you if you're positioned wrong. Explicit cautions, high implied volatility, watch market pricing big moves in either direction, not just up. A forced short liquidation could send silver sharply higher. A coordinated bank intervention or a liquidity event elsewhere could force funds to sell everything, including silver, temporarily pushing prices down hard. On Shanghai's open, it could come in at a massive premium, confirming the recycler data. Or it could open more cautiously as Chinese institutions digest how far Western prices moved while they were offline. On Mexico, the risk is real, but current supply data has not yet registered a hit. There is a difference between elevated risk and actual production loss. Timing and magnitude are unknown. The transcript pulls in Mark Douglas from Trading in the Zone. Edge comes from probabilistic thinking, not certainty. The structural thesis and the timing of its expression in price are separate questions. Anyone telling you they know the exact date silver goes is not doing analysis. They're doing something else. Segment 7. Why the thesis is stronger today than yesterday. After all those caveats, the core argument doesn't weaken. It strengthens. The Shanghai recycler data gives a rare direct look at what real Chinese physical demand is willing to pay when the exchange is closed, and it's nearly $10 over Western paper. The COMEX volatility spike tells you the options market is bracing for something, structure under stress. The naked short problem has not been solved. It has continued to build. Gold at $5,150 while equity futures open. Red shows you where institutional capital is parking right now. Everything that was true about silver's structural setup yesterday is more true today. Multi-year deficits, tight physical, rising geopolitical risk, legal and macro uncertainty in the fiat system. Price has moved some, but the underlying system has moved further. Segment 8. What to actually watch tonight. All of this converges on one practical point. Shanghai's open tonight is the most important price signal of the week. Here's how to read it based on the transcript. Compare levels Western silver, around $86. Recycler bids, $95 to $96. Watch where Shanghai spot and futures actually print on open. Check the gap. If Shanghai opens close to recycler levels and well above Western spot, that confirms Chinese physical demand is materially above Western paper pricing. It increases odds that Western prices will have to follow. Watch the 88.289 resistance zone. On Western charts, the 88.289 band is the only structural obstacle between current price and the next leg higher. That zone needs to be cleared with force, not lightly tested or camped inside. Monitor CME vol and options verify the implied vol data from CME yourself. Watch whether vol stays elevated or spikes even further after Shanghai opens. The people who do this work, who track recycler pricing, Shanghai's gap, CME vol, and that 88-89 band won't need anyone to explain tomorrow's move to them after it happens. They'll have seen the setup. Segment 9, outro. You've been watching John AG here, and I'm OG John AG. If this helped you understand why Shanghai's open, a 95-96 recycler bid, spiking COMEX volatility, naked shorts, Mexico risk, and Middle East hardware all converge into one story for silver. Hit like so this doesn't get buried, smash subscribe with all notifications on, and drop a comment. 86 on screen, 96 in China. Which price do you believe? Tell me whether you trust the Western quote or the Chinese cash bid and how you're positioning. because on this channel, this is financial warfare education, not hype. We don't just watch candles. We watch who's paying real money for ounces when the exchange is closed.